Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon for those of you here on the East Coast. We're just after 12 noon Eastern time. And of course, good morning to those of you in the Central time zones, Mountain time zones, or Pacific time zones as well. And good early morning to any of you who are joining us from maybe across the pond, parts of UK or parts of Europe. I guess it would be good evening, or good morning to those of you maybe joining us from Australia or Asia. Well, welcome to the next segment of our discussion on using the married put approach in your portfolio. And today we're going to discuss the role of the income methods, the adjustments that we use against the married put structure for specific reasons. And we're going to cover that today. Now, we recently shared with you the initial presentations of Is the Married Put Right for You? Talking about how the proper structure stacks the market odds in your favor, how it compares to other strategies over time, and the three core principles really of any investing strategy and how the married put approach applies those directly. Then we looked more in depth into the proper protected structure. What risk should we look for? Is there such a thing as too little risk? And yes, there is. And of course, why not sell a call right away or do an adjustment on your position right away? And that takes us to the role of the income methods. After we open the proper structured married put position, we're going to use the income methods to essentially achieve three factors. We're going to generate income, but we want to do it with a meaningful premium that doesn't get us into trouble with the improper structure. We're going to use that income to increase our return, lower the cost, and of course, the second goal is lower the initial at risk to keep us even more safe on the position. We also want to be able to keep the upside reasonable. Not necessarily open all the time, but we want to keep a reasonable upside without having too limited of an upside gain. And we definitely do not want to have two ways to lose in the structure by applying one of the income methods. Then eventually, of course, we want to bulletproof the trade, get to a position where we still have our insurance policy in place, have no risk on the position, and have no risk without sacrificing further upside and still achieving the targets for the position. That's the role of the income methods in a nutshell. Now, there are 12 different income methods. Really, there's 13. But why are there 12? Well, for different market conditions. What are the three outcomes when I enter a married put position? Well, the stock can move up to my expectations. And the best income methods to use if that happens would be income method number 1, number 3, number 4, number 5, and number 6, 2 of the riskless spread trades that are used against the married put structure. The stock might stagnate over the first 20 to 40 days. I'm not really seeing what I expected from the underlying security. Well, that's fine. I could potentially use income method number 6 as well. I can use income method number 7, income method number 8, or perhaps income method number 11. 8 and 11 are sort of a condor and a butterfly done in the proper structure. But of course, in some scenarios, the stock's going to go against my expectations completely and fall in price. And if I'm anticipating a fall, well, if the stock falls or I'm anticipating a fall in price, could use 6 again, could use number 9, very powerful, could use a combination of 9 and other income methods as well, or use income method number 12, which has saved 2 positions that I had in the past couple of years, where the stock fell, in one case, 35%. We took in a 10% profit. Another time the stock fell 60%. We took in a 4% profit on the position using income method number 12. It's also been extremely useful in other situations. But let's talk about the initial structure. We're going to use one of the actual trades on the Fusion subscription where Ernie and I share our positions as an educational format for Blueprint owners to see how we use this approach in our personal portfolios and use the income methods as well. Back on November 11th, we opened a married put position on DAR. We bought the stock at $49.21. And for the proper structure, we purchased the April 55 put for $9.10. Now that looks expensive. It does make the total investment $58.31 out of pocket. And you can say, well, that break even is $58.31. That doesn't look like a reasonable trade. Well, we covered that in the other videos. That break even is only if I hold this position all the way to expiration. Make no adjustments, accept no dividends, then yes, at April, I need the stock to be trading at $58.31. Put gives me a guaranteed exit of $55. Meaning even if the stock fell to $10 per share, we're guaranteed to get $55 back. So the maximum risk is only $3.31 per share, or 5.7% of the total investment. Now, I had an email from last night. Is it a good idea to write a covered call with married put trades to increase the return? I wonder what percentage return you can expect then. Well, we do sell a call against it. That's just income method number one. There's a free white paper you can get at radioactivetrading.com which shows an example of income method number one. But done in the wrong way, this can actually minimize your returns from your original expectation. It can actually take on a higher risk. And it can put you in a position where you have two ways to lose. So it does not satisfy the role of the income methods done incorrectly. Done correctly, it can be very powerful, and that's just one of the 12 income methods. Now let's go back to November 11th. DAR was trading at $49.21. We have highlighted here the trade entry when the stock was, just above 48, hit 49, went above the upper Bollinger Band. We bought the April 55 strike, had a mix of intrinsic value, about $6, so the true risk is only $3.31. That's the time value of the put option is our true risk on the initial setup. On November 11th, we could have decided to sell the 18th of December 50 strike call for $1.85. Or we could have gotten 60 cents by selling the further out of the money December 55 call. Are these the proper things to do? No. This is why the blueprint is important. It details the full guidelines, how to use each income method and how not to use each income method, and what we call the SIGA model, the decision-making process for deciding which income method to use. The basic rules and guidelines for income method number one, just selling a call against the married put to create a collar position, is we want to wait for the stock to move up as expected. We want to keep the expiration time frame under 60 days. I personally prefer under 40 days if possible. We want to generate at least 1% of premium against the underlying stock price. We want to be able to sell that call to cancel the initial risk by at least a third or a half. I never want to sell a call below the put strike price. And I want to meet the other guidelines or roles of the income method so I don't get myself in trouble. The improper income method number one is trying to force premium right away, doing it at the wrong strike price. On November 11th, when we entered into the married put position on DAR, selling the December 50 call for $1.85. Did it generate income? Yeah, we took in $1.85, so that's a check. Did we reduce the risk by a third or a half? Yes, we did, in a sense that our initial risk to the downside was $3.31, and we generated $1.85. So we took the risks down by more than half. But did we give a reasonable upside? Not really. Remember, the stock was at 49.21. If we sold the 50 strike call right away for $1.85, the stock's trading right at 50, we'd see about a 1.9% return. You go back to that initial presentation when we talked about the proper protected position. When I enter a married put, as I did with DAR on November 11th, it's because I have the expectation that this stock could potentially go up 3 to 6% in the next 20 to 40 days. Well, as we can see, we have achieved that with the DAR position. If I did nothing and allowed the stock just to move up with the married put, and it went up, let's say 5% as I was expecting in the first month, I'm still expecting to make 50 to 60% of the stock movement with that proper protected structure. In other words, I might be at a 2.5 or 3% return without an income method in the case that the stock did meet my expectations. That's much higher than this one peak right at the 50 strike call of 1.9%. So this did not give us a reasonable upside based on my expectations. In fact, when you try to force the income method too soon, you take in too little of a premium, we actually are trading against ourselves, aren't we? This is a bearish position against my expectation of the stock moving up in the first 20 to 40 days. And you can see that it's a bearish position because it does not keep me out of trouble. I've actually increased the risk, doubled it from 5.7% to 11.4%. Not to the downside, but to the upside in the direction I thought the stock was going to go. So forcing the income method in the wrong time frame and not following the guidelines is actually now trading against yourself. Buying a put to ensure your stock position is not trading against yourself. That's ensuring a large investment. That's a smart move. Forcing income methods improperly and not following the rules in the blueprint can lead you to trade against yourself, get you into trouble. And of course, now we also see that we have two ways to lose. We can still lose slightly to the downside, though we did collect half of the premium against that. But now we can lose to the upside in the target area we thought the stock was going to go. That's how an income method can be done improperly. And that's why it's important to have the blueprint, to have the full story of all 12 income methods. But let's go back to that discussion of the improper income method number 1, selling the December 50 call right away. As we near December expiration, the stock was at 54.41 on December 11th. Well, our 50 strike call is now in the money. It's going to cost us $4.60 to buy it back. But we kept that 185, but now we're adding to the cost and we're adding to the risk by 275. The 460 minus the 185. This would now make the total risk on the position, if I bought to close that call done incorrectly, to $6.06, almost double what we started out with the initial married put position. That's going in the wrong direction. Now you see the trade entry marked here on the initial position for November 11th. Then I have this line here, this red line drawn across at around 52. What does that line represent? That represents the price within the first 20 to 40 days where my expectation was for the underlying security, a move of about 5%, up to about $51.50, $52. And that was hit just prior to the 30-day mark. This is the best time to do an income method. Not right away. Not if I feel it's stagnating after the first 5 or 10 days. You can risk overtrading the position by not following the rules in the blueprint. I want my expectations to be met and do the income method at the proper time. That, of course, is also described in the blueprint in regards to the timing. But you can see here how just saying, hey, I've been trading options for a while. I've been trading covered calls for a couple years, or even the last 6 to 8 months. You've probably had success in the last 6 to 8 months. That market trend and the current volatility for high premium is likely not going to continue for the next 6 months, 8 months to a year. Market conditions are going to change. But you look at our married put structure and you say, okay, that's great. They're controlling risk to single digits. I've had some covered call losses. I've had some high percentage losses on just buying calls or doing credit spreads. So I like this idea of limiting risk. But I know covered calls. I know selling premium. So let me do it right away. But we've already shown how that not only can get you into trouble with the improper structure, but how by trying to act too quickly, trying to force the income method too soon against the rules in the blueprint can get you going in the wrong direction. You'd actually potentially be increasing your risk on the position, and that's not matching the role of the income methods. We want to pay attention to the whole structure of the trade. So what's wrong with getting more upside? Selling that December 55 call for 60 cents. Hey, it's 60 cents I didn't have yesterday. It's 60 cents I didn't have when I initially opened the position. So on November 11th, let me sell that 18th of December 55 call for 60 cents. Does it meet our guidelines and criteria? Generated income? Absolutely. 60 cents I didn't have yesterday. Did it reduce the risk by 1/3 to 1/2? No. This is only about 1/5 of the initial risk of 331. Does it give a reasonable upside? Yeah, the stock's trading right at 55, kind of where it is now. We could expect a 3.7% return, a 3% return, where it is maybe now just at about 55.50. Okay, so that's not too bad. Does it keep us out of trouble? Mostly because we don't really have an upper and lower break even. We still have that lower break even. We still have a risk of 271 or 4.7% to the downside. We took that 331 risk and lowered it only by 1/5. Didn't meet the rules of the blueprint. And maybe if the stock went up to 60 or 70, a sudden run upwards, that income method number 1 does cap the upside, just like your covered call position. But doesn't look like we'd hit an upper break even, a second way to lose unless there was a large unexpected run. But this is also important to note with the basic income method number 1 strategy. The most obvious choice against the married put, hey, just sell a call, generate income. But you have to keep in mind that like the covered call, this does cap the upside. And why does this slope move down? In other words, if I bought the stock at 49.21 and I sold that December 55 call for 60 cents, we'd expect to see a standard covered call position where if the stock went up to 57, 58, 59, we'd have a return of, 4, 5, or 6%. That's speculative out of the money covered call position. It could go up to 80. We still expect the same return. Why in this structure do we see the gain tailing off? Well, remember the initial married put I'm doing on a bullish position, a stock I expect to move up. With the proper structure, we still have a positive delta, meaning if the stock moves up 2 points, I'm only expecting to lose $1 or 90 cents on my put option. I'm still gaining to the upside in the first day or the second day if the stock moves up in price. But when you do income method number 1, we are capping the upside. So as we get close to expiration, what happens to this call? If it's in the money, it goes to a delta of 1. Our put option now maybe only has a delta of 0.5, 0.45. So as the stock continues to move back up at the strike, we have a 1 delta on the stock, a negative 1 delta on the sold call, and the put is still losing value. So the position as a whole still sees some tail off after hitting the strike price of the short call. But that again is what's available in the blueprint is what the targets are when using this income method, and of course, how to use it properly. By the way, so this didn't meet all of the goals. It didn't meet the reducing the risk by a third or half, which is relatively important, so we don't see too much of this tail off as the stock goes above the short call. And as we got closer to December expiration, the buyback cost of that 55 call was $1.40 because the stock did move up as we expected. So what does that mean? Now, we're not adding as much risk to the position as selling the improper 50 strike call. This is also an improper structure, forced too soon, because we're going to be adding risk to the position. I have to pay to buy it back. So I'm adding 80 cents to the risk, would take us up to $4.13. I'm sorry, $4.11 from that 331 initial at risk. So how do we get the proper structure that we want? Again, by following the proper approach. We want to wait for the stock to move up in price. We want to make sure the selection for the income method meets the guidelines and the roles for the income methods. Also has to meet our expectations for the stock going forward, and we have to apply the proper structure, not just for the married put, but for the income methods as well, so we don't get into that position where we're getting ourselves into trouble, trading against ourselves by forcing an income method too soon, and potentially having two ways to lose. Now, before we look at what is possible today, to review a few of the income methods, let's talk about the put. It's not just insurance. I paid $9.10 for that April 55 put on November 11th to control my risk to 5.7%. The put doesn't go to zero as soon as I entered the trade. It still has 5 to 6 months of time value remaining, and the price is going to fluctuate based on one of the three core principles, two of the three core principles actually, that we discussed earlier. The most important is the at-the-money bell curve. What the at-the-money bell curve shows us, of course, is that when we're buying options for protection, or buying options even for speculation, we want to be buying in the money or out of the money to pay into a lower time premium. And when we're selling, we want to be selling closest to the current stock price to get advantage of the high or swelled extrinsic or time value. Look at the numbers differently. I know this is an old image that I prefer to use, but let's take some of the different stock prices. In relation to DAR, on November 11th, this would be the 50. Stock was trading at $49.21. 50 strikes were right at the money, and on any expiration, had the highest time value at that time. This would be the 55 strike. The one that we purchased over here would be the 60. So we purchased this to pay into intrinsic, but also pay into a lower time value to keep that risk to single digits. And of course, down here on the out of the money side for the puts, this would have been our 45 strike, which the stock would have had to fall 5 points before the insurance kicks in. So although it had a lower time value, it's not the proper structure because we'd be looking at a risk of 12, 15, maybe even 20%. The stock has to fall 10% before the insurance triggers. That's why this is our target. Now, in the first 30 days, the stock moved up as we expected. Our 55 strike put is now at the money. The 60 strike put is on the outside wing over here with the lower time value. Why does that matter? Because the put does lose value. As the stock moved up to $55, breached it a couple days ago, but is still trading above 55 today, my put option's out of the money. That 55 strike put is below the current stock price, but it has a time value or extrinsic value of $4.90. So what does that mean? Does that mean I lost $4.20 on the put? Well, yes, it does, but this is all time value. all extrinsic value. That 420 I lost, I more than made back with the gain in the stock. My original risk, my original time value was 331 when we structured the proper trade, and now it has increased to 490. That extrinsic value swelled because our 55 put is now at the money. How can we use that to our benefit? Well, that's income method number 4. We can swap the time value by rolling up the put. So remember, we entered DAR at 49.21. We bought the April 55 put at 9.10. We do have a cost basis of 58.31. Now, I can sell to close the 55 put for 490. Yes, I'm taking a loss on the put, but now I can buy the April 60 put, which is on the proper end of the ATM bell curve, for 770. Wait a minute, that's a debit. That's not an income method, that's a debit. I'm entering in a debit here of essentially $2.80. Why? To get a 5-point higher payout, a 5-point higher guaranteed exit. So essentially, we're lowering the risk by 220, which is more than any income method number 1 following the rules would generate right now. The January 55, which I wouldn't use, the January 60, they're well below 220 of extrinsic value. This movement cuts our risk down from 331 to 111, or only 1.8% of what we have invested in the position. This is the only income method that's done at a debit, but the payout is usually better than doing any income methods if your expectations are the stock's going to continue to move up in price, and you still have the ability to use any of the other 11 income methods after you do this income method number 4. This one gives you the power to reduce the risk in the proper situations by more than half of what you initially started with. Again, it's the only one done at a debit, but is extremely powerful, and it's probably one of the ones I use the most often in the right situations, probably about 65-70% of the time. But again, we can still do other income methods in combination, even though we've increased the cost basis, but we've managed to cut the risk down by more than half by using income method number 4. It's not just insurance. The put is a second working asset that we can use to further lower the risk, and some adjustments we can even lower the cost of the position in addition to lowering the risk, still leaving the upside open. Now, all that being said, let's take a look at power options. We're going to see what income methods could be used today on the DAR position. We're going to show you benefits of combining income methods, and we're going to talk about a riskless spread trade, one of the 3 riskless spread trades in the blueprint that allows us to get income right now, leaves the upside open, and can easily be combined with other adjustments. And of course, we're going to use the portfolio tools to evaluate these adjustments so all the math is done for us. So let me pause the screen real quick. Going to switch gears now and head on over to the Power Options suite of tools. Just make sure the view changes. Fantastic. So, as I'm looking at Power Options, naturally the first thing we want to do is we're going to go to the portfolio tools where we track our open positions, married puts, and others. And in the main portfolio is where we view the positions. Fusion subscribers will recognize most of these. The AEM married put that's posted in the Fusion subscription in my portfolio. There's our DAR position as well. This is the webinar account, so we have some comparisons there. Also the craft position. What's not shown here in the webinar account is the newest married put we entered on RBA, Ritchie Brothers Auctioneers. But let's take that DAR position. And as I'm tracking any position in the portfolio, we can go to Position Actions and then Position analysis. This is important for the married puts as well as other trades because it gives us a breakdown of our current position. We know our current risk on the trade. We still have 100 days left to expiration. The option price changed from when I set up the slides this morning to where we are right now. Stock's at 56.08, so the puts declined a little bit more from where we saw it at 55.57, but that's fine. There's still a variety of income methods that can be used now, and even to potentially bulletproof this position. So we scroll down below and we see our current liquidation value and our future expiration value. Again, if we held the position all the way to April expiration and do nothing, and the stock stays at 56.08, yeah, I'm not at my break even. That's not the plan. We don't just open the married put and expect it to run up and do nothing. This is where the role of the income methods come in. And right here, we have a variety of different income methods that we can use. And it's shown for us. And these are calculated based on the rules in the blueprint. So here I have some opportunities for income method number 1. Under 60 days out in time, we can sell the February 60 call for $1.95. What would that do? That would lower my risk by $1.95, pretty much lowers it by half of the 331 we expected, a little bit more, of course, excuse me. So the new risk would only be 2.4%. Well, that's not a bad income method. It matches the guidelines. Does it keep us out of trouble? Well, once you see a rollout opportunity available, we can delve deeper and go into simulate trade. And this gives us a side-by-side comparison of the original married put position with our risk of 5.7% and what the new position would look like if we sell this call against the married put position. Down below that red hockey stick graph, that's our initial married put. And the blue line here is showing us the new position where we have that peak potential profit of 9.8% if the stock's trading right at $60 on February expiration. This looks like it solves all the problems. It matches the roles of the income methods and the guidelines for income method number 1. But are there other opportunities other than just selling a call? Absolutely. Let's go back now. There's some opportunities for income method number 4. Now that the prices have changed for our April 55 put, it's only at 470, we still see we can roll up the April 60 put. For a price now of 760, now we're getting 20 cents less. We're getting 470 instead of 490 as we saw earlier. And it's going to cost us 760 instead of 770. But this adjustment alone takes our risk down to only 2% to 121. Slightly lower risk than selling the call, which did cap the upside. True at 60 and beyond, but in this case, we could lower the risk even further by going to the April 60 strike put. Only take a risk of 2%. Now, I could also bulletproof the position, have no risk on the trade by rolling up to the April 65, paying a higher debit, so we still sell to close our put at 470, buy the higher strike put at 11.15, so about $6.40 debit, but to gain 10 points of guaranteed exit from 55 to 65. That's a fair trade-off that I look at with income method number 4. 70 put as well would take us to a bulletproof status of 2.8. Why am I not considering these right away? Again, because of the guidelines in the blueprint. This matches what I would look for an income method number 4. But just like I don't want to initially set up the married put position using a put that's too deep in the money and may take my risk down to only 1 or 2%, if I decide to use income method number 4, I'm going to select a strike where I think the stock is possible to hit in the next 20 days to 30 days going forward from today. Not hedge myself out by going potentially too deep in the money, where yes, we have a great bulletproof status and a great no-risk position. But Now, I might have a harder time doing other proper adjustments because I went too far above the current stock price. The 60 and the 65 are reasonable, but I think I'd target the 60 in this case for a potential income method number 4, as we showed on the slides. Let's look at having the math done for us and the side-by-side comparison. It's great to see things numerically, but you can delve deeper and take a look at the positions graphically. Once again, on the left in red, we have our current married put, 5.7% maximum risk, still with infinite upside. If we apply this income method number 4, sell to close our put for around 470. By the April 60, slightly in the money, following the ATM bell curve for 760, again, yes, we do increase our cost basis, but now we've reduced our risk by more than half, and we still leave the upside open. Fantastic. That's a great thing to see. And it's a reasonable price away from the current stock price. Why is that reasonable? Because now I can still do other adjustments against the position. Whereas if I was at the 65 strike, I might not be getting as much premium as I'd want. By selling the 65 call or doing a riskless spread trade around the 65 strike, keeping it to 60 allows me to still generate more income on the position. Are there other income methods available? Absolutely. Scroll down here. Here's an interesting one. Income method number 6, one of the riskless spread trades that I mentioned. Doing a bear call credit spread against the structure of the married put. Why would I use a bearish spread on a position that I'm bullish on? It's because of the proper structure. This doesn't create a bearish change. What this will do is allow us to get income, in this case only about 50 cents for this particular income method number 6 trade. But I'm selling a call at 60. In this case, buying one at 70, but I own the stock. So essentially this becomes like an income method number 1, a covered call to create a collar with an extra bought call option that leaves the upside open. And because we own the stock already, where I would normally have to put up 10 points of margin requirement and add 10 points of risk to a position with a bear call spread to cover the difference in the strike prices, your broker just sees this as a covered call with the protected put in place and an extra long call position. You do not have to cover any margin. There is no risk, additional risk to the upside as the stock moves up, and the upside remains open as the stock continues to grow. Income method number 6 is a great one to use if the premiums are right, and it solves that problem of income method number 1, the most commonly and obvious, I want to say commonly used, but the most common and obvious one against the married put structure. Just sell a call like you would in a covered call. That's great. We saw how that could cap the upside. We saw how it done improperly can get you into trouble. But this income method number 6 solves one of those problems with income method number 1, where your upside remains open if the stock really has a large run. Yes, you still have an obligation here to deliver shares of stock, but as the stock continues to move up, the long call is also gaining in value to leave your upside open. No additional risk is entered. Remember, we saw the 50-cent net credits, and we only dropped our initial risk from 331 down to 281, almost 1%. Not quite as much as I'd look for with the income method number 6 position. I'd usually want that to generate 1% against the risk, to lower the risk by at least 1%, while still being able to leave the upside open. Now, we see here a good potential and a good target, as I mentioned, to pick a strike price for income method number 4 that would cut the risk down by more than half and still leave the upside open. But can we combine income methods? Absolutely. There's a full chapter in the blueprint that discusses the best combinations of income methods when you're evaluating the position because the stock met your expectations or even went against your expectations. Let's take a look at the what if calculations here. It'll take us to the profit and loss chart, and we're going to manually see that income method number 4 we just discussed and how to potentially improve on it with the 2 income methods we just reviewed. So what is our first action? Well, I want to simulate selling to close our April 55 put now that the stock has moved above it. Did we lose on the put going from 910 up to 470, 460? In this case, we did. Okay. What did we lose in this case? Well, with a midpoint now at 470, we've essentially lost $4.40 on the put. In order for that to happen, the stock has moved up just about 7 points. So that 440 we lost on intrinsic value is covered by the gain on the stock. And this time value of 470, remember that 55 strike put now is all time value. It's all extrinsic value. It swelled because of the ATM bell curve because we were at a time value of just 331 when we opened the position. Now we're at a time value of 470. And the intrinsic gain we lost is more than covered by the stock position. Now, although we lost 410, what's our second component for income method number 4? Picking a reasonable strike price in the money where we still expect the stock might hit in the next 20 to 40 days, just like when we opened the initial married put. So we're going to go back into April, keep the same expiration in this case, and we're going to use the 60 strike put. We see the midpoint's down now to about 750, I believe, 755. I'm sorry, not 750, 760. That's okay. So we're just going to buy one at 760. Again, what have I done? I added a debit of $2.90. Do the math right there? Yeah, $2 roughly and 90 cents to gain 5 points. This is right in the wheelhouse of what I'd look for with income method number 4. I'd like this to be a little bit lower, and it was earlier, but now that the stock has moved up, the price has changed slightly. But in the blueprint, we discuss what targets to look for. What is too much of a debit to add when increasing the strike prices of your position? Okay, this meets the goals of what we look for the SIGA model for income method number 4, that decision-making process. And what do we have? We have lowered our risk from 5.7% down to 2%, and we've left the upside open. And that's just in the first 30 days. We still have a reasonable return if we liquidate it now. If I did this income method number 4 and decided, okay, let me liquidate the position, the put doesn't go to 0. It's still going to be priced at 750, 760, or 770, and my stock's still trading at 5608. So we're still going to get a reasonable profit against this position, even though we added to the debit. But can we improve on this? Absolutely. Our risk is down to 121. We're now at the 60 strike put with a stock at 5608. We already saw we could sell the February 60 or the February 65 and get a good premium. But what about shorter term now? Let's just go January, 17 days out. DAR only offers standard expiration. Yes, you can use weeklies if they match the guidelines. Well, the 60 call only gives us about 70 cents. Okay, only about 60 cents or so in premium. But again, that's half of the new risk that we have. That's not a bad trade-off. Let's go ahead and see what happens here. We'll get about 62 or 63 cents, applying 4 and 1 together. Doesn't cancel all the risk, but now we're down to a 1% risk on the position. Potential still to make 7% or more if the stock's trading right at 60 on our strike. But we do have a large, steep tail off after the stock goes above 60. Why are we seeing such a steep tail off? And it's again because maybe I'd want to consider using the February. It's under 60 days out in time, but it's going to give me a better profit on the position. It's further out, but under 60 days at a time. Let's just take a look there. It came up in the rollout opportunities because maybe this one isn't giving us the right premium. Why didn't I see the January 60 and the January 65 when we went to that position actions menu from Power Options? And that's because it wasn't satisfying the rules and the guidelines for income method number 1. Let's do that February strike. Let's sell that. See what we get. Now we're bulletproof to 1.2%. Still have sort of a steep fall off, but max return around 8%. The stock is trading right at 60, but all reasonable profits within the range here. The stock's trading anywhere between 50 to 70. And I would do this if this matched what we call my SIGA model, which is described for each income method and each adjustment in the blueprint. The SIGA model stands for conditions, expectations, your goals, and the answer to those 3 determines your action. What are the conditions? The stock has moved up to meet or exceed my expectations in the first 20 to 40 days. I've decided to use IM number 4 to cut the risk by more than half, still leave the upside open at this time. And what are my expectations? The stock may continue to move up towards 60 or 62, barring any unknown event, which is why we have the put in place to begin with. But those are my expectations. What are my goals? Well, to have a lower risk position, if not bulletproof, while still generating income, to increase my return properly, not get myself into trouble in either direction. And those determine my action. This would likely satisfy my SIGA model after using income method number 4. But let's say that I know something's coming up. Potentially something's coming up between now and February expiration, or between now and January expiration, say, such as an earnings report. Income method number 1 after the 4 caps the upside. I could be giving up profit if earnings come out, say, late January, and the stock does go up to 68 or 69. Is there a way to still generate income, lower the risk, and potentially bulletproof the trade, and leave the upside open? Well, absolutely. That's the income method number 6. That riskless spread trade we talk about, the bear call spread. I still may sell the February 60 call for $1.95, but if it matches the structure and the rules in the blueprint, I might give up some of that $1.95 to buy a 65 strike call, and probably about 70 cents or so. Let's just see what the true midpoint is. It's 72.5, 73 cents. Let's just call it 75 to purchase this call if we get close to the midpoint. That's my bear call spread. We've sold the 60 and bought the 65. Just with the bear call spread, it's a net credit of $1.20, which was what? Equal to my new at risk after using income method number 4. I don't have to put up the 5 points of margin because my broker sees that this short call is covered by the stock, and I just have an extra long call position. So I'm entering a bearish spread on a bullish structure, which generates premium that almost covers my entire risk and leaves the upside open if the stock continues to exceed expectations, goes up to 68, 70, 72 after earnings. No risk to the downside. Covered that extra $1.21 evenly, generated income, and left the upside open. That is the power of the income methods and how to use the income methods correctly. You don't want to try to force selling a call too soon. You don't want to try to force even using income method number 6 right away when you open a married put. And you could say, oh, but the upside is open if I use income method number 6 and I get premium. Why wouldn't I do that? What was one of the other rules roles for the income methods. You don't want to have two ways to lose. If I open an initial married put today and sell a call for too low of a premium at the put strike price and buy a further one, you'll see a position that has a low return, dips back down into the loss, and then will come back up in price. So you have two ways now to lose. To the downside, because we took too small of a premium, didn't allow the stock to move up to our expectations, and we lose to the upside if the stock is between the strikes. Yes, there's infinite upside, but it needs much more room to grow. It's much better, and following the rules, even though this income method number 6 leaves your upside open while generating income to help you solve and fulfill all the roles of the income methods. You don't want to do it right away. You want to wait for the stock to move up to meet your expectations to see a higher profit. Get a better premium. Follow the rules in the blueprint. Now, a question comes up, of course, if I enter the married put and I sell a call right away, let's just take a new example. Let's go just into the search. Let's go back here. Let's go into the new married put search and just take a position from scratch to show more of these quick examples of why we don't want to force the income method right away. Let's go back to the standard search sorted by earnings per share growth. There we go. And I'm going to use this one here. It's got a nice risk of 6.7%. I'm not going to start off too high at 8% or even 7%. I'm not saying this is a position on FL Serve that I would enter. I want to do my further research and analysis on power options, take a look at the chart, company information, other potential strikes against it to match my goals. We reviewed that in the last webinar. But let's just take FL Serve, buying the stock at 112.31 and the January 125 strike gives us a risk of about 6.5, 6.7%. Again, let's take a look at the profit and loss chart. I enter this married put and I say to myself, okay, the stock's at 112, and yes, I'm buying the 125 put, but I'm going to ignore what Mike said. I'm going to ignore what's in the blueprint, because if I sell the 120 call or the 115 call for January, just 17 days out, that's 40 or 50 cents that I might not have had today. So we're going to keep standard expiration, although FL Serve offers weeklies. The 115's at 130. Okay, but there we go. The 120, what did I say? 40, 50, 60 cents. That's right where it is. Let's just take the 120. Too low of a premium. Doesn't cancel my risk by a third or half at all. Not even close. Neither did the 115, honestly. I'm below the put strike price. That's a no-no. Because what this does now is actually create a bearish position. My risk goes up to 9.9% from 6.7. We increased our risk by about a third, not to the downside, but to the upside in the direction we thought the stock was going to go. And this isn't a bad return, but we have capped it that if it's just at 120, we're only seeing 2.7%. If it goes up to 120 or 125, hits our targets that we expected of that 5% increase or so, now, okay, 118, 119, we'd probably have a higher return just on the married put without selling the call first. About the same, actually. I'll say that honestly. Be about the same in that case. But this is the improper structure. Now, sold the 120 call to get at least some premium. Why not do income method number 6 now? Buy that higher strike 125. Well, number one, there's no premium really here. Let's take this out. Let's go further. Let's go 30 days out using the weeklies to, let's say, end of January expiration. I'm going to keep that 120. Now we're going to get about 85 or 90 cents. We're going to buy the 125. There's our bear call credit spread, 5 points. We're going to say a net credit of about 50, 55 cents. But we don't have to cover the extra margin because our broker sees this as just a covered call against the stock put in place and the extra long call. So now we take a look at doing this income method number 6 right away. Oh, sorry, there we go. Okay, so the net credit with the midpoints, we're talking 57 cents. Did we lower the risk? Absolutely. Just by about 0.5, 0.6%. But this max return here, if the stock's trading right at 120, not too bad. A profit of about 355, 3% or so, 3.5%. Okay, a little lower, 3%, let's call it. And then it doesn't go negative. That might be okay. And we do have infinite upside. But I want to see a much better chart for income method number 6. I'd like to see the stock. My expectation was it was going to go up to 116, 117, maybe even 118. Then I might look to do an income method number 6, getting better premium and with the better strike prices. This done too soon and at too little of a premium isn't really satisfying my goals for the risk lowering. Does leave the upside open, that's great. Does generate premium, but not in the range that I'd want to see. Many times what you see, we had to go out 30 days, remember, because if we did the other one, we would dip back down here, have 2 ways to lose, and that would be a third strike against why I wouldn't use this income method right away. All right, so that's how we use power options, of course, to evaluate which income methods are available, where all the math is done for us. We saw the benefits of combining income methods. We saw the riskless spread trade, income method number 6, using that bear call spread against the position, where we generate income but do not have to put up the margin requirement to cover that initial trade. It does not increase the risk because we own the stock already. That is the role of the income methods. Generate income correctly with a meaningful premium, not forcing the income method too soon. Generating income that doesn't get us into trouble by forcing it too soon. Increasing the return and lowering the cost. Lowering the risk as well while keeping the upside reasonable. Income method number 4 is very powerful, not at an income, it's done at a debit. But the amount of risk that you lower is going to be higher than pretty much a call premium that you'd see following the rules for income method number 1. And of course, we don't want to have 2 ways to lose, which we saw as a common occurrence when doing the improper structure. And then, of course, eventually bulletproofing the trade to have a no-risk trade on the position without sacrificing upside and still achieving your targets on the position as well. Now, all 12 income methods are only available in the blueprint, the full description of when and how to use them, how not to use them, and the SIGA model. Today, I shared with you a third of them. We talked about income method number 1, just selling a call to create a collar. I pretty much gave you almost the full story. We reviewed the guidelines of what we want to look for with income method number 1, how to do it correctly, and how to do it incorrectly where it doesn't solve the rules in the blueprint, the rules of the income method, and can get you into trouble. I shared with you income method number 4, done at a debit, but it typically lowers the risk by most, even with the high volatility and high premiums we've seen in the last couple months. Income method number 4 in the right conditions can cut your risk down by more than half. And it's just one of 4 ways that second working asset, the put option, which is not just insurance, can be used to adjust the position, lower the cost basis, lower the risk, and potentially bulletproof the trade. And we shared with you the bear call spread, income method number 6. Mostly I just showed you examples of it. I didn't go through the details. That's why you need the blueprint, of course. But this is one of 4 really riskless spread trades. There's income method number 5 is using a ratio call spread. It's a very powerful one that can get you extra profits more than income method number 1 or income method number 6. Using the condor structure, 2 different forms of condors in the radioactive trading structure, and a broken wing butterfly is one of the other income methods as well. Of course, I'd mentioned 13 income methods. What's the 13th? It's do nothing. If I'm in the married put position and I review my SIGA model and none of the income methods match the current conditions, my expectations, and my goals, then I'll do income method number 13. I'll do nothing. That's a valid income method. Wait for the stock to move up further to get better premiums. Or if you expected the stock to move up and it didn't and it falls, well, I'd be looking to use a different income method than just selling the call. And that's all what's described in the blueprint as well. And of course, I have to remind you, as we go through this, during our end of year promotion bonus offer for the blueprint, there's only 2 days left to pick up your blueprint. You can head over to radioactivetrading.com/EOY to take advantage of the 8 special bonuses. You'll get a discounted first 2 months of Fusion, where I mentioned that Ernie and I post our trades. You have a basic search and continued lessons to help you master the married put and radioactive trading approach. First 2 months for only $10. It's usually $69 per month. So you'll have more time to get the education, further education, and more. And you can activate that at any time. You don't have to start right away. If you pick up the blueprint, you can go through the materials, wait a month or two, and then start those bonus discounted months at any time. There are 6 Mastery Series CDs, videos that go along with the blueprint and what's called the Home Study Kit. It contains about 12 hours of webinar discussions similar to this, in addition to the full blueprint. That's the Home Study Kit. But we're going to give you the first video for free. It's usually $89, the Foundations of Radioactive Trading, if you pick up the blueprint before December 31st at midnight. We're going to include an additional video, the 4 Insider Secrets of Trading. And you're also going to get a quick start guide to help you to start using the married put strategy directly in your account today. You'll get 1 month of power options, which I showed you today, completely free. So you can start tracking your positions, evaluating income methods, search for the proper married puts as well. The blueprint is now an electronic copy. If you purchase the blueprint before December 31st, we'll send you access credentials to go to our educational website, learn.powerop.com, where you'll be able to start going through the blueprint immediately. You don't have to wait for shipping. You don't have a bulky 3-ring binder around. You can access it directly once your purchase is made. Of course, you always receive email and phone support for free. And there are a variety of members-only blueprint webinars and Fusion subscriber webinars, members-only content that you can access at the free registration account at Radioactive Trading. So you'll be able to get that right away and start going through some of the older material and newer material for members only as well. Now, I have a quick question that came in. Okay, I'm sorry about that. Let's see here. Let me navigate over here. I know you're still seeing my screen. Give me 1 second. And let's see. Am I still there? Yes, I am. Let me do this. All right, so Suresh simply asked a question. Where can I find the link to the last webinar you've talked about, please? Okay, well, one of them you can access directly. Oh, I'm sorry here. Suresh, give me 1 second. Okay, great. I'm sorry, Suresh. There's 2 ways you can access some of the recent webinars that I was referring to. There we go. The first one you can see at radioactivetrading.com under the free webinars tab. There's the link for the proper protected structure. What risk should we look for? Is there such a thing as too little risk? Can't I bulletproof the trade right away? Why don't I sell a call right away? So you can see that right here at Radioactive Trading. Or go to our YouTube channel. Go to YouTube, search for Power Options. Here's our little icon. And you see the recent presentations that we've done. Is the married put right for you? That was from about a week ago. That was the first presentation. The proper protected structure. We talked about that initial married put structure, Suresh, and what to look for. And then this one here, best ways to generate income. That was a discussion that we had from a YouTube comment, as well as one of our discussions from the open discussion last Wednesday at 4:30 p.m. Eastern Time, related to the decision-making process of when to use an income method. And then, of course, today we went deeper into that with the proper roles of the income methods. And I essentially reviewed 2.5, almost 3 income methods with you. But the full story, again, is only available in the blueprint. And now, of course, is the best time to get your copy of the blueprint before December 31st at midnight to lock in these 8 special bonuses before the offer ends December 31st at midnight. Now, one question real quick that came in via email earlier this morning too is Ron had sent an email in addition to the other gentleman who asked about selling the call against the married put to increase the returns. But Ron said, well, what are your go-to income methods? He also asked, what are the different income methods for, up, down, and stagnant markets? We already reviewed that earlier in this presentation. We reviewed which income methods, didn't share all of them. And that's why the blueprint's there, so you can get the full details without getting complicated at all. They're all written out very simply without all of the unnecessary options jargon, so you can use them effectively. When Ron said, what are your go-to income methods? Honestly, most frequent uses in my account in order are income method number 4, income method number 1, income method number 9 if the stock goes against my initial expectations, but I feel strongly it's going to recover. That's a great way to lower your cost basis and get more upside profit potential. Income method number 6, the bear call credit spread, very useful. Income method number 12, hey, we didn't review that today, but that's the structure that allowed me to stay in the stock the entire time. And on the Penn Gaming position from a couple of years ago, be in the stock for a couple months that dropped 33%, we were able to take a 10.6% profit while being long the stock. Also, in that case, there was that evil one. In that case, I think it was Epics that moved against me drastically. In a 2-month period, it was down about 60%. We were able to take a 4% profit on the position. That's using income method number 12. Income method number 5, conditions have to be right, but when the conditions are right, and you can find it to match the guidelines and rules in the blueprint, extraordinary powerful. 10 is just to choose to decide to use a dividend-paying stock or not. And at any given time, about 20 to 25% of the married put positions I have in the Fusion portfolio are dividend-paying stocks. Okay? They move more slower, but can still give you a good advantage, and with the proper structure and proper application of the income methods can be extremely powerful. But that's deciding to do it off the bat. I wouldn't recommend doing 100% of your married puts with dividend-paying stocks, but taking a portion of the positions that you have open is a strong one. So those are sort of my go-tos. I would say, honestly, 4, 1, 9, 6, of course, 12, and 5 when it's available. I'll be honest, I don't think I've done an 8 or an 11 in at least probably 3 years. The market conditions weren't right. That's done for a specific reason, and you'll see why in the blueprint. So remember, make sure that you take a look and get your blueprint before December 31st at midnight, before the special offer ends. You can read more information about it at radioactivetrading.com/EOY, or just go to radioactivetrading.com, click the products tab, click on the blueprint. You'll be able to review the bonuses there and pick up your copy before the special offer ends December 31st at midnight. And again, make sure you get access to the blueprint before then so you can lock in your bonuses, start trading with the proper structure of limited risk trading today, and get the full story on all 12 income methods. We shared a few of them with you today, but the full details are only available in the blueprint. If you do have any other questions, think of any other questions later on, send us an email to support@radioactivetrading.com. Remember, you can also call the office at 302-992-7971. I'm actually not going to be available for the next 20 to 25 minutes after this webinar ends, but anytime this afternoon, feel free to give us a call. This webinar is recorded. We will process the presentation, get it set for you, and we'll send you an email later on this afternoon, probably in an hour or so, when the webinar is available on the archives at Radioactive Trading and on our YouTube channel, as we showed for Suresh. Take care, everyone. Thank you for joining me today for the role of the income methods presentation. Make sure to pick up your blueprint if you haven't done so already to lock in those 8 bonuses. And I'll see you soon. Take care.